Hello YouTube, it's the Accounting Tutor and we're back for another weekend video. Last weekend I published the video What are Assets and Accounting for Assets. I republished that again in this Sunday just gone to update it for some information that I've taken from this upcoming video, and to change the format around a little bit to make it more useful to you, the viewers. Today's video is what are liabilities and how do we account for liabilities as well. So let's dive straight into it. Liabilities, just like assets, make up part of a company's financial position or their balance sheet. So if we remember the accounting equation, assets equal liabilities plus equity. And normally they appear towards the middle, just above equity and just below assets when you look at a statement of financial position or balance sheet in a company's accounts. Now, just like assets, they're split into current and non-current. A non-current liability is one where the obligation is not expected to be settled within the next operating cycle of the company, which is usually 12 months. Whereas a current liability is one where there is an expectation that it will be settled within the next 12 months or within the next operating cycle of the company. We will cover the different items that make up liabilities towards the end of this video. So let's dive straight in to what the definition of a liability is. Now, simply, in what people normally think is a liability is money that you owe someone else. And that's not far from the truth. But again, it's been defined within the Conceptual Framework, and the definition is this. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. And again, just like assets, what does that mean? But let's go through the different parts of this and see if we can decipher it. So let's start with present obligation. A liability is a present obligation. So what is a present obligation? Well, this occurs from an obligating event. An obligating event is one in which a company has no other option than to settle the outstanding obligation it has now or in the future. If a company can avoid paying for something in the future, then it cannot be a present obligation. Now, this obligation can be legal or it can be constructive. So what does that all mean? So an obligating event is simply something which you can't avoid paying for. You can't avoid settling it in the future. Okay? Now this can occur legally, whereby you are obligated legally and there could be legal recourse if you do not settle this transaction. Or it could be a constructive obligation. Now, what is a constructive obligation? We covered it slightly in the video on assets, but just to remind you, as per IAS 37, a constructive obligation arises from an entity's actions, through which it has indicated to others that it will accept certain responsibilities and as a result has created an expectation that it will discharge those responsibilities. So this is whereby the conduct of a company historically or in its normal course of business is outside of the legal requirements that it's imposed on itself, but because it does this in its normal practice, it is expected that this obligation will exist, and the customer or the other party is expecting that a company outlays something in order to meet this obligation. So what are examples of this? The first example is of a retailer's return policies. So legally, a retailer may say you only have 30 days to return this item, and no sale items can be returned. If you have no receipt, then an item cannot be returned, etc., etc. However, in practice, companies may be more generous than they're legally required to. And that builds a brand reputation, that builds a positive image for the brand. And if they don't keep to this, then it may cause reputational damage. So if they've done it historically and it's the normal course of business, then we may have to recognize that there is a constructive obligation greater than what is legally there. Similarly, fixing items outside of warranty. And then if we go into employee costs, then you have two things: long service awards. So if an individual is paid or given a gift after 10, 25, 50 years, and however much that gift may be, a company is not legally obliged to give that. However, in their normal course of business, they see it as beneficial to do so, and they have historically done it. And therefore, they should recognize a liability for it, because an individual may be expecting it, and also the company has historically done it. Similarly, retirement benefits, which may be paid greater than any legal obligation. You could have dismissal costs, loss of office costs, a lot of different areas which may be covered off by this. But they're all forms of constructive obligation. So why is that word present important? Just like in assets, that word present means that the obligation exists currently. Now, it may not be settled now, it could be settled later in the future, but an event has occurred which has already created that obligation. This is covered off in more detail when we look at what past events are defined as. Okay, so we now know what a present obligation means. So let's look into the other parts of the definition. A liability is a present obligation of the entity arising from past events. What does past events mean? And is it the same as in assets? Well, the answer is it is the same. So, just to remind ourselves, and I know it seems obvious, but a past event or a past transaction is one in which a valid expectation has already been created in other parties that the entity will discharge the obligation. Now, this obligation, as we've said before, can be contractual or constructive. And as described when we're describing what present means, it can occur in one of two ways, whereby the economic benefits have already been obtained and therefore there is a duty to transfer an economic resource to settle the transaction, or whereby a present obligation may arise if the past event has given rise to a contractual or constructive need to transfer economic resources before the economic benefits are received. Okay, so therefore something has happened which has created this expectation from both parties that there is a transaction that is required, there is an obligation that needs to be discharged, and there is an economic resource that needs to be transferred in return. So now we understand what past events are. So we know a liability is a present obligation of the entity arising from past events. Now the last bit. the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Well, we know what economic benefits are. We spent ages going through it in the last video. I'm not going to spend as long going through it in this video, but we will just run through them quickly. So, different ways an economic benefit can arise is, simply if you were to sell an asset, an economic resource, then you would receive cash or something else for it. Okay? So, an outflow from the entity will be its stock or its computers or its receivables or its investments. Whatever it is that you're selling, that's the economic resource that is outflowing from the entity, the resource that is outflowing from the entity, and in return the economic benefit you're receiving is cash or something of equal value. Similarly, you may have a contract already in place which you're receiving cash for. That contract is your trade receivable. Okay, it's your trade receivable. It may be your accrued revenue. Okay, it may be the revenue that is owed to you. So that is flowing out and you are receiving cash in return for it. You may have a situation where another economic benefit could be where your economic resources are creating goods or services for you. That's the economic benefit, that they're helping you create goods or services. So what is the outflow in this case? Well, you are spending money. There is a cash outflow. There may be payables outflow. And for that you are receiving an asset, machinery or cars or computers that help you to produce products. Or you may be in a situation where the economic benefit you're receiving is that it is enhancing the value of another asset. It's enhancing the value of another economic resource. We gave the example last week of replacing a plane engine. That will increase the value of the asset. It increases the longevity of an asset. And therefore, you can capitalize that and capitalize it as an asset. It is an economic benefit. So your outflow in that is cash, because you're spending cash to buy this new asset that's enhancing your value, and that's creating an economic benefit. And lastly, it could be something you exchange or settle or lease for another economic resource. Yeah? So in that case, it could be anything. You could be outflowing anything. You could be exchanging your trade debtors for PPE. In that case, it's the outflow is your debtors. The inflow, your economic benefit, is getting PPE or fixed assets. You could be settling it for payables, therefore that obligation is being settled. Yeah? So you're giving over cash to settle an obligation. Or you could lease out, you're getting money and you're giving up the lease of a building or the lease of another economic resource. But essentially all it's saying in that sentence is there is this two-way flow. It will result in an outflow of something from a company, and that outflow must be of economic benefit to the recipient company. Okay? So that's what that term economic benefit means. So that really covers everything of what a liabilities definition really is. It's a present obligation arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. So why don't we have a look at the different types of liabilities that exist? Okay, so the first one, most obvious one that a lot of people would know, are trade or accounts payables. This is where you have received an invoice from a company for a good that they have distributed or are about to distribute, or a service that they have or expected to complete. So you owe that money that is on that invoice. That is a trade payable. Now, why is that defined as a liability? Well, it's arisen from a past event, whether that event be that the duty has already been performed by the other party, yeah, or whereby the good has been transferred from the other party, or whereby there is a contract that asks you to pay that money, yeah, and therefore a present obligation exists from that invoice, and the settlement of that will cause you to have to pay money over, and so it's usually settled for cash. So that's why it meets the terms of a liability. Now, interestingly, if someone has sent you an invoice for something that will occur in the future, so they haven't sent the good, they haven't undertaken the service, there's no agreement that you need to pay early, at that point in time, when you have received that invoice, it does not constitute a liability. That is not a present obligation, it is a future obligation. You have not received the economic resource, so you cannot book an asset. Therefore, you cannot book that in your financials. Now, from a practical standpoint, people working in AP, they have to book that because that's how the systems usually work. So you have to book it within your AP, but at the same time, you usually create a debtor of the same amount. And it's for the management accounting departments, when they do their reporting, that they have to net those amounts down. Okay? So that's an important caveat to watch out for. The next thing we have are bank overdrafts. So these are whereby you have gone into the bank's cash balance, into the bank's resources, and you are using their money. So, and therefore your obligation is that you have to give that money back to the bank. It's not yours. And that's why it's a liability. That's the same case for bank loans or any loans that you have with a company. You have borrowed money and you owe that money back, and therefore it is a liability. Credit cards will be covered by the same thing as well. Next we'll go into accruals. So what are accruals? Accruals occur whereby a service or a service has been completed or a good has been passed on to you. Yeah, and for both of these you're expecting, you have a PO for them, or you're expecting that you have to pay for these. You're expecting that these services have occurred. But no one has sent you an invoice for these services. However, from a matching concept, you have received the service. It should be going through your accounts. Therefore, you need to match it with the account in the accounting period. Therefore, you need to recognize this accrual. So it is for services and goods received that haven't yet been invoiced. From a practical standpoint, this usually in accounting departments or in AP departments, you have to look at your POs, your open POs, your open purchase orders, and see which ones have already occurred, and therefore how much you need to accrue for. And sometimes this can only be an estimate, because the accountants or the AP team will only be able to know this if they know the goods or services that have been transferred. So the next one is corporation and VAT taxes payable. So usually you don't pay these as you go. There's sometimes a bit of a delay, either at the quarter end or or at the end of the year, or 9 months after the year end. There's always a bit of a delay for you paying your taxes over, and therefore this liability which you owe the HMRC or you owe tax authorities needs to be recognized within your financials. That is a current obligation because the tax arises from your current activity. Interest payable is also the same. So what interest payable is if you have a bank loan, if you have a bank overdraft, then the banks, or even if you have a loan with a third party or intercompany, they will charge you interest, but it's usually 1 month later, and therefore this 1 month worth of interest payments which you're contractually obliged to pay needs to be recognized on your balance sheet. And the last one is provisions. So what are provisions? A provision is a liability of uncertain timing or amounts, as defined under IAS 37. So what does this mean? So in normal cases, we're pretty definite on the amount that needs to be paid over in a liability. But in the case of provisions, we aren't fully sure. But we know that there is a contractual or a constructive obligation of the amount that we need to pay. Therefore, we need to do a best estimate of what that will be. Now, these may be things for one-off events. One-off events may include things like restructuring costs. So this is when there is a sale of an operation or a closure or reorganization of a company, whereby we need to estimate or make a best estimate on the costs involved in closing that operation down, including redundancy costs of individuals, etc. It may also be a dilapidations provision. So when we take a lease out of a building, there is usually a clause which says that the building needs to be returned to its present condition, to the condition it was when you got the building. That is called a dilapidations provision, whereby it is the best estimate of what it will cost to return the building to that original position. There may be other things which are for large populations of events, such as warranties or customer refund costs. Now, they're all calculated based on a probability-weighted expected value, rather than measured at the most likely amount. You then have things like settlement of lawsuits. That's also measured at the most likely amount. So, in all of this, there's some uncertainty around if it will occur or how much it will occur for. So we've covered the how much, and the if is really is it probable? Is it probable that it will occur? Yeah. So it must meet all the other definitions. So a present obligation resulting from a past event, which can be estimated reliably, but in addition the payment is probable, which is more likely than not we're going to have to pay. It cannot be possible. If it's a possible obligation, then it meets the criteria to be a contingent liability and is disclosed but is not accrued. But we will cover provisions and how they're calculated in a separate video. Okay, so now you know what liabilities are. You've got examples of liabilities. So when do you recognize them? So we've actually covered both of these 2 points earlier in different parts of the video. But the first is, which we've covered before, the item's cost or value can be measured reliably. And the second one, it is probable that future economic benefits will flow from the entity. So there has to be that idea of probability that this will actually occur. So what does probable mean? More likely than not. If it is not probable, if it is only possible, you do not recognize the liability. It is only disclosed in the financial statements. So thank you. That's it. Thank you very much for watching the video. If you liked it, please smash that like button. Please subscribe to the channel. I'm also joining all the social media platforms, so please add me on Instagram. I am the.accounting.tutor. On Facebook, it's facebook.com/the.accounting.tutor1. And I have also joined the podcasting world. So I am now on Podbeam. If you couldn't get enough of me on YouTube, then you can join me on Podbeam, where all of my episodes are uploaded. And you can listen to me in the car, on the train, or as you're falling asleep. So the website for that is www.podbean.com/theaccountingtutor, where you'll find a list of my episodes. But you'll need to download the Android or the Apple app. I'm also going to be releasing these on Apple iTunes and the Google Store as well. So thank you, enjoy, take care, and I'll see you for the next video.